everyone. This is Vijay presenting on the most look forward annual shareholder letter from Warren Buffett. He published it on Saturday, 2 days ago. Just went through and analyzed what he was thinking and what he wrote in this 2021 letter. Interestingly, straight off the bat, a good CEO always measures what they can manage. He wants to measure himself against S&P index in terms of the returns, and that's the first page of the letter. This has been is focus all these years, and you can see two things. One is Berkshire handsomely beats the S&P index, hands down. That's one, and two is long-term focus. So 1964 till 2021. So and continuing fourth, right? So that's the key. There are 25 lessons in this newsletter. So 12 pages of all gem, life advice and financial advice, so on and so forth. So let's get started. The first one. This is all about. He talks about a lot of people buy Berkshire shares. And he believes that they are owners like him. So, and he's honored by the trust. Trust is a key factor in Warren Buffett. The way he manages his company, his stakeholders, that's key. Second point he tries to make is he wants to write a letter that even a child can understand. That's what he means by this. That's very important. In terms of communication, we all should be cognizant of that fact. Third thing is about publishing this letter during the weekend so that the market absorbs the news, which is very interesting. And the other piece is treating all shareholders equally. I think that's important. The most important piece in this page is I think in terms of intrinsic value. So you can clearly see his focus has always been on the intrinsic value of the business, not on the price of the shares. That's key focus. So anyone running business, they should focus on intrinsic value. That's his key point there. The other piece here he mentions is about investing in durable economic advantages, those kind of businesses, and a first-class CEO. What he means by here is investing in businesses that has got moat. For example, there's investment Coca-Cola, where consumers don't change the habits in terms of switching from Coke to Pepsi. Gillette, which is the premier razor that folks use, Kraft Heinz, so on and so forth. So those are kind of the businesses he loves, where the business has a moat and it's very difficult to penetrate and run by world-class CEO. So that's another key. And they're not stock pickers, and they're essentially focused on picking good businesses. And in fact, in my YouTube channel, you'll see that I focus on business model. The reason for that is one needs to understand the business model before you can understand how the company is doing whatever they want to do in terms of selling a product or service and collecting those money and paying off the suppliers. The key thing is to understand the business model. And I think there's a clear focus on acquiring good businesses. The other piece is the vulnerability itself. Warren Buffett accepts the fact that he's vulnerable and he has made mistakes. But the key thing is he learns from his mistakes and builds upon it. That's the key. Surprise, surprise. Berkshire always will be building, he says, and that shows his long-term focus. Very, very key. If you're a founder, you should have a 7, 10-year, 20-year horizon. And we saw in the Jeff Bezos video also on my channel that Jeff had a clear long-term vision. So world-class CEOs have this kind of long-term vision of growing their businesses like owners. Here he talks about the Berkshire Hathaway merger way back in 60s, the mistakes that they committed in terms of capital allocation. That's the key message here. And then he talks about how he redeemed himself from that by deploying the capital into other good businesses, and thus compounding the returns on other businesses, and thus getting out of the textile business itself. The textile business in the 60s and early 70s was eaten with Chinese imports, and Berkshire Hathaway died a natural death because of that. Let's see what he talks about here. He talks about luck and providence. Most of his letters here he talks about long on America, lucky to be born in America, those kind of messages. And then again, he talks about lucky to hire someone like Ajit Jain who runs the insurance business, and he clearly mentions it here that the day he hired Ajit was his lucky day. So those are the couple of quick things that he mentions here. And then he talks about float. Float is the most important concept for an insurance company. Of course, Berkshire Hathaway is a property and casualty insurance company. So what they essentially do is they insure businesses. They have a lot of insurance companies like that. Apart from that, you have something like Geico, which does auto insurance. The simple example is a consumer would pay an auto premium against their auto insurance. That premium sits as cash in Berkshire Hathaway, in Geico. So that cash is handled by, at the corporate level, by Warren Buffett and Charlie Munger. What they do is they deploy that float that is available. Anything excess can be charged by customers. In case of auto accidents, consumers can file claims, and they can, so the Berkshire needs to have some kind of cash in hand, and we will see down the road why Charlie and Buffett tend to hold large amount of cash. Other pieces, but that Berkshire's float can be maintained without incurring a long-term underwriting loss. That shows his confidence about his insurance team. One of the world-class insurance teams that does amazing modeling, actuarial. It's called actuarial modeling. So the ability to keep the gross combined ratio, which is the key ratios in insurance companies, around 85-90, it's very important. And that's what I think Warren Buffett is mentioning here. Talks about having 4 major positions here, but let's talk about Apple here, right, for a moment. Apple is 5.6% stake, $31 billion at cost, and now worth $161 billion, right? The funny thing is, Warren actually sold some Apple stake in 2020, and Charlie Munger kind of admonished him, so he understands his mistakes, but I think kind of redeemed that. And he talks about how brilliant the CEO is. So a couple of themes is finding great businesses that has got moat, and second thing is, run by great CEOs. That's the key message here. And then in terms of investing in BNSF, which is a rail company, is very key. Its timing was very fortunate because of the uptick in the market from 2009 till recent times. But the key thing about here is he talks about accounting practices. So if you're analyzing a company, the key message here is to do accounting forensics. That's what he's saying here. And if you scroll down further, it talks about BHE, which is utility. Utility companies are great during inflation because utilities has to be utilized by consumers and businesses, and consumers and businesses have to pay for utility. So utility companies do have a purchasing power. Of course, they're mandated by regulators. So it's a good play, and they are moving in the direction of eco-friendly, right, in terms of solar, wind, and transmission, so on and so forth. So good company to keep an eye on. And as you scroll down, we saw in earlier that how he takes the float and invests, and this is where that investment goes. And if you see, the key message here is only 16 odd companies in which he has invested. So he's taken the float, put that capital to deployment. So at cost basis, 104 billion. Now it's worth 350 billion, right? And you can see marquee brands from American Express all the way to Verizon. But his biggest bang for the buck came from Apple. You can clearly see Apple has given the huge sizable, nearly 50% of this, 45% of the returns has come from Apple. The other piece here is he talks about Occidental Petroleum, investing in them. He has a preferred stock and warrants. The key thing is someone like Warren has a good Rolodex, so he can get preferred. So preferred is essentially, guaranteed rate of returns, which is higher than the market interest rates. So, and then warrants is basically at a future time, he would be able to exercise that share at a certain price. So that's the benefit he's got. So there's definitely returns baked in. Probably is like, example, Goldman Sachs, he did a $5 billion at 10% preferred. So he was collecting, close to $500 million, right? In terms of the preferred return. And then his exercise price was around 117 for Goldman Sachs, if I'm not mistaken. And the share price at that time in 2008 for Goldman Sachs was around 65 when he did that deal. So he has that kind of Rolodex and to do those kind of deals. The other piece here is he talks about accounting again, which is managing Kraft Heinz on the equity method instead of the market value. So you can still see his deep dive, very strong in accounting, knows how he thinks and how he handles his statements. we talked about the float, right? Berkshire Hathaway is a property and casualty company, so they might end up paying unforeseen premiums to for claims against claims. That's why they hold a huge cash, $144 billion cash, and Charlie and Warren have agreed to hold at least more than 30 billion. This is the reason that they are they have a strong balance sheet. They have massive cash to deploy to acquire companies, but at the same time they want to hold on to 30 billion odd because they might foresee some claims from businesses and consumers during unforeseen reasons. This one is interesting. When he first invested shares, it was around Dow Jones was 99. Today, I think it's probably around 33,700. So massive uptick. So what he's talking about here is long US. That's key. Always in equities. The other piece he talks about is he couldn't find any way to deploy capital, and ultimately ended up purchasing Berkshire Hathaway's shares. I think this is the best section in this whole letter. Talks about share repurchases, and you if you can't deploy capital as a CEO, then there are limited amount of choices. So as a CEO, you can deploy the capital for organic growth. You can use the capital to acquire other businesses. You can pay out dividends. You can buy back shares, or those are four or five things you could do. And clearly, he could not find deals, so he went into buying share repurchases. But he clearly says two things, right? The interest rates are high, so the valuations are high. But I think Charlie and Warren bought Berkshires at fair value. That's what I ascertained from this section. So that was that. And like every time he talks about a story, he talks about Paul Andrews, who was the founder for TTI, Textronics. Paul is an amazing CEO. He was down in the dumps when he bet on himself with $500 and started this company and grew to a $7.7 billion company. In this section, Warren talks how he was fortunate to meet Paul through another contact of his, which shows that networking is very important. The other piece is Paul himself wanted to, when he was trying to sell the company, it shows the empathetic side of Paul, and he ended up selling the company to Berkshire Hathaway after evaluating the fact that whether he should sell it to a competitor or should he do a leverage buyout. He did not, because he wanted to protect his dependents, his family, his employees. He didn't want anyone to get affected by the acquisition or by the sale. So he ended up selling it to Berkshire. Because of that, which was, I think, because of TTI, which was headquartered in Texas, he ended up investing in BNSF, which is the railroad company which we talked about earlier. So it talks about luck and fortune and providence. That's key message here. So a lot of things can happen to us also in life like that. The other piece is he took a massive position in BNSF at that time in 2009, when there's a key adage that Warren sticks to, which is be greedy when others are fearful, and that's what he did when he took the stake in BNSF. So that's the key, and he did the deal in 11 days with BNSF. That's a major stake for